Let me ask you a question. Have you ever wondered whether you should invest your money into the market now, or you should perhaps wait until the price is a little bit lower? I get asked this question all the time, both from beginner investors as well as more experienced investors. And I also wonder that myself pretty much all the time, right? I'm always thinking about investing. It's what I do, right? So in this video, I basically wanted to answer that question and illustrating that by showing you what would happen if you were the worst market timer of all time, if you basically just bought stocks at the very peak every single time over, pretty much all your working life. Now, I've got this video idea from a great article that has been recommended to me a lot that was written on the site A Wealth of Knowledge, but it was back in 2013. And this article basically tells you the story of Bob, which when I was reading that article, I was just picturing Milton behind me. That's from, a character from Office Space.
They've moved my desk 4 times already this year, and I used to be over by the window and I could see the squirrels, and they were married.
It's a great movie. I really recommend you watch it. And it's actually got a surprisingly cool kind of twist at the end that makes you reconsider, what's actually important in life. Okay, so I really recommend it. So this guy, Bob, he's now retired, but he started his career back in 1970 at the age of 22. And besides being the most unlucky guy in the world and the absolute worst market timer in the world, only investing at the very, very peak of the market, right? He was a diligent saver. So this guy, used to save all the time and he had a plan, okay? And he's stuck by that plan. And you'll see in the end of this video what results he got. And actually make sure you stay till the very, very end of the video because I'm actually going to show you what I personally do in terms of timing the market. So this was his saving plan, okay? During the 1970s, he was going to save $2,000 every year. That's it, just $2,000. And with every decade that passed, he would save $2,000 more than the decade before. So in the 1970s, he would save $2,000 every year. In the 1980s, he would save $4,000. And in the 90s, he would save $6,000 per year, okay? Pretty doable. I think most people are able to keep saving more money over time the more they get promoted. So that's basically what Bob did over those decades. So by December of 1972, when the market was at all-time high, Bob had saved $6,000. And everyone was telling him, dude, you have to get in the market. It's a great way to make money. You have to invest, right? Everybody was really, really positive, which is what tends to happen when the market is at all-time highs. People look back, they look in their rearview mirror and they see all the gains that they've made. They see that their neighbors have made money and they just want to get in on that money-making, carousel, okay? So that's basically what it did. Bob invested $6,000 right at the very peak. Following that, the market crashed by 48%. So, Bob saw that money that he had been saving for the last 3 years be pretty much worth half of what he invested, right? That is a really, really tough psychological challenge. And I'm gonna go deeper into this later on in the video because that's actually a really important aspect of timing the market. So by 1973 to 1974, when the market was all the way to the bottom, Bob just kept saving, okay? That was basically his one saving grace, that he was a very diligent saver and he consistently saved money every single month, okay, to make up those $2,000 per year in the 70s. And he kept saving all the way up to 1987. By then, the market had gone up tremendously. He was feeling a lot more comfortable. He was actually making money in the market, at least, paper gains. And everybody was just feeling great about the stock market. And by that point, Bob had $46,000 saved up, more than a decade of hard savings. However, of course, very unfortunately, he invested all those $46,000 right before Black Monday in August 1987. If you've seen the movie Wolf of Wall Street, one of my absolute favorites, then that's basically that big crash that, meant that Jordan Belfort was out of a job. So this is the explanation, okay? That was Black Monday in 1987, after which the market dropped insane amounts in a single day and it carried on going lower and lower, and there was a recession and eventually the market dropped by 34%. And once again, Bob didn't feel so good about his investments. However, he didn't sell, right? He never, ever sold. And you know, along with being a really good saver, that was his second saving grace, that he never sold, and he basically had nerves of steel. You know, he saw his money being decimated by the stock market, but he didn't sell. By the way, this should be obvious, but you know, I'm assuming that Bob was able to invest into an S&P 500 index fund, okay? Later on in the video, I'm gonna tell you what results he would have got today, all right? But I'm just assuming that he invested in a really low cost index fund. Not that there were any available back in 1972, but still bear with me, you know, this is just a story to kind of, you know, make you realize that perhaps being the worst market timer is not the worst thing in the world, but I'm kind of getting ahead of myself a little bit there. So from 1987 until 1999, right before the dot-com bubble, Bob kept saving. This was now the 90s. He was saving $6,000 every single year, just saving them up. And right before the big bubble burst of 1999, he invested all that money, which by this point was $68,000. But as you can expect, and I'm sure you already know, in December 1999, the stock market pretty much lost half of its value, okay? Once again, Bob was just thinking, look, this is basically what investing is like. You know, I don't really like it, but I'm just gonna keep my money where it is. I don't wanna actually experience those losses, and it doesn't matter, I'm gonna keep saving and saving. And at this point, it was the 2000s, you know, he saved $8,000 every year and actually invested all of that in October 2007. That was $64,000 by this point, right before the housing crisis, right before the Great Recession, which I'm pretty sure that if you're watching this right now, you are at least aware of that one. Pretty much all of us experienced that to some degree, you know, whether we didn't get jobs or whether, you know, our investments dropped in value. So one last time, Bob had to endure that pain of seeing his investments drop by 52% this time. Okay, that's from peak to bottom, or from peak to trough. That's the loss he made with that last tranche of investing. And at this point, as is understandable, Bob was pretty tired of all this, right? Of being really bad at timing the market. His friends at work all made fun of him. His wife made fun of him. Pretty much his children made fun of him, right? At least that's what I imagine happened to this fictional character. So for the rest of his working career, all the way up to 2013, he just saved money and didn't invest it anymore, okay? He was tired of the whole thing. So now we're going to assume that Bob went to sleep and woke up now in November 2020, right after the pandemic stock crash. You know, the stock market is pretty much at all-time highs for some reason that I don't quite understand. I'm still expecting another drop personally. I'm now going to show you what we've been waiting for, the results. I'm going to show you how much money Bob invested overall, and I'm also going to show you how much all that investment would be worth right now. Now, I'm going to assume that he reinvested every single dividend that he earned into buying more shares, into increasing his savings. Okay, that's another assumption that I have made here. This is by no means, you know, the perfect calculation, but it's probably close enough. So in the end, Bob invested $184,000. That was the total amount that he invested in the market. I'm excluding all the money that he saved for the latter part of his career. Okay, that's unimportant because it didn't grow, but $184,000 is the total amount that Bob put into the market. Now, excluding inflation and having reinvested all dividends, you know, to really keep that compound interest machine rolling, his portfolio now in November 2020 would be worth just over $2 million. Now, you might be watching this and thinking, this doesn't take into account inflation. What is this guy talking about? He should take inflation into account, which is exactly what I've done. The total value of his portfolio, taking into account real inflation data, okay, would now be worth $706,000. That is still a lot of money, taking into consideration that he only invested $184,000 throughout all those years. So I think we can all agree that this is a very considerable amount of money, especially taking into consideration that Bob invested at the very peak every single time and experienced pretty much the biggest paper losses that anyone would have experienced. And it still ended up with $700,000 most of which is actually market gain. So what about you, dear subscriber, or at least I hope you are a subscriber. If you are not, make sure to subscribe to the Escape into Freedom YouTube channel, and make sure you give this video a like, because I always put a lot of effort into my videos, and you know, the more likes they get, the more the YouTube is going to get them and, you know, recommend them to other people, and the more likely I'll be to make these kinds of videos. Okay, so yeah, subscribe. Make sure to hit the little bell icon to be notified whenever I release a new video, and make sure to like this video as well. So those 3 things in exchange for hopefully a pretty informative and entertaining video. So now you've seen Bob's story, but what about you? How likely is it that you're going to be as unlucky as Bob, right? You're not going to be. That's the reality. It's very unlikely that you're going to invest all your money right at the peak or even near the peak, right? Now, of course, you could dollar cost average, which is what a lot of people do, especially people that invest in index funds. They dollar cost average. You know, perhaps every month they will buy a little bit of that index fund, that S&P 500 or FTSE 100 or whatever you are into, every month diligently. That way you're going to get the peaks, you're going to get the troughs, and overall your average cost is not going to be as bad as if you dumped all your money into the market at the worst possible time. However, something that's very, very important, and it is especially important if you are a beginner investor, is that it's very likely that you will invest your money and you will be in the red, right? On paper, if you look at your brokerage account, it's very likely that for the first year or 2, you will actually be losing money. That is just the reality of it. I also experienced the same thing. You know, the more you stay invested in the market, the less likely that is to happen. However, you know, you have to be like Bob, basically. You have to have the mental fortitude that Bob had, and never ever sell stocks just because you feel fear. Now, if you want to sell a specific stock because, you know, they've cut the dividend or the company is not as good as it used to be, that is a different story, right? But when it comes to index funds, you really shouldn't be selling because you are already very well diversified. Now let me tell you what I personally do with my investing portfolio. I normally look for opportunities, right? I always look for opportunities at all times. I don't really care whether the market is high or it's low, okay? I have my screening process. I use dividendcompass.com, which is an app that I personally made myself. There's going to be a link below in the description of this video. And that actually lets you, you know, sweep through the whole American market and find opportunities. Find stocks that are undervalued, even if the market is at all-time highs. And let me tell you something, in you know, my several years of investing experience, I've personally found that there are always opportunities. There are always companies that are undervalued. It's true that right now, again, in November 2020, there aren't that many companies that are really undervalued, okay? That is true. I'm not really finding that many opportunities, but there are still some opportunities. And in fact, last week, I made a video showing you 3 dividend growth stocks that look fairly undervalued right now, okay? I'm gonna put a link to that video right here in this corner. Am I pointing that right? Yeah, more or less here, okay? So if you are looking for stocks that are undervalued, make sure you check out that video. Make sure to subscribe to this YouTube channel. Once again, I really appreciate your support, guys. So yeah, guys, in summary, what I really want you to take away from this video is not to be afraid of the stock market. You're investing in really high quality companies, especially if you invest in the S&P 500. There's a lot of companies that are really, really high quality in there. And you know, even if you do like Bob and you invest at the worst possible time in the world, you're still going to come out on top. You're still going to come out on top way above most people that don't invest. So my advice to you, and again, this is not financial advice, it's just what I would do if I was in your situation, if you're wondering whether to wait, is probably to invest, right? Just dollar cost average, invest a little bit every month, you know, diligently save. That's probably the biggest point, really. Just save diligently, save a big chunk of your salary every month, and just save, okay? But this works better if you invest in index funds where you can't really look for opportunities. On the other side, what I personally do, and obviously it's what I do, therefore what I would probably recommend even more, especially if you invest in individual stocks, which is what I do, is to just save, right? Build that pot of money and always be on the lookout for opportunities in the market. And then when you find an opportunity, when you find a stock that has a higher dividend yield than it normally has, or it has a lower PE ratio than it normally has, right? That's normally somewhat of a trigger to find undervaluation in stocks. that's when I deploy my money, okay? So that's what I personally do. I really hope you found this video helpful. I really hope you've enjoyed Bob's story. I'm gonna put a link to the original article just in case you wanna read it. And yeah, guys, that is everything for me right now. I also hope that you enjoyed my kind of new studio. I put some cool lights in the background. They can change colors and everything. Let me know what you think. Let me know if you've enjoyed this video, right? And let me know what your strategies are for market timing, whether you dollar cost average or you do like me, where you can just always save money and are always on the lookout for opportunities, or whether you just invest all you've got at once, right? Let me know in the comments below. Like this video, subscribe if you haven't done so already, and also share this video with someone who perhaps might be a little bit hesitant to invest, right? Do any one of those things and I'll be very grateful to you guys. Thanks again for watching this video, and I will see you in the next video. Take care, guys.